the way you take strategy and execute on a strategy, it's always about decisions on where you're going to put those scarce resources. And if you're not doing those efficiently, if you don't have the visibility into where the constraints are, then you're going to run into problems. So when you roll up the portfolio, there's typically, there should be a prioritized list of projects that are in alignment with your strategy, but there's always going to be some, what we might call pet projects or zombie projects or projects that are languishing that we're investing in but aren't quite getting the bang for the buck we expect. We need to call those out and make some tough decisions. Where I get nervous is when you say you want some investment in the longer term, and then when you actually roll up the projects, you're actually spending a very small amount, if anything, in those longer term, because the near term is going to win out every time because that's really the way a lot of leaders are incented. They're incented to hit their quarter over quarter numbers. So it's hard to talk about this topic without getting into incentive systems and how leaders are measured. When you're dealing in high uncertainty territory, when you're going into new markets with new technologies, then your business case is almost worthless, because we know we're just guessing at the growth rates, because it's never been done before by definition. So those hockey stick growth curves can be meaningless. It's more important to identify what are the high impact assumptions that we're making, and let's go and test those assumptions.
Hello and welcome to the Enterprise Tech Talk podcast. I'm your host, Saumitra Kalikar. Now, it's fair to assume that all organizations have corporate strategies, but not all strategies result into measurable business outcomes. And despite heavy investments into digital transformations, AI, and technology modernization programs, many organizations continue to struggle to realize their strategic ambitions. And this raises an important question as to why strategy execution remains such an important challenge for most of the organizations. Today, we will explore this question through multiple angles. And to unpack the topic further, I'm joined today by Noel Sobelman. Noel is the strategy and innovation advisor with more than 25 years of experience in helping organizations improve their investment planning, portfolio management, and execution planning capabilities. He is also author of a book titled Innovation Portfolio Management, Linking Strategy to Execution. Noel, welcome to the podcast. Great to have you here.
The pleasure to join you, and looking forward to our conversation today.
Noel, before we get started, can you tell us a little bit about your book? What's its overall focus area and what inspired you to write the book?
Yeah, so I've been advising companies for over a decade now on all aspects of innovation and new product development. And one consistent theme is there seems to be a disconnect between that ambition, or whether it be a growth goal or a purpose-driven mission, and the actual projects that you're investing in. When you roll up, kind of do a bottoms up of project projections and maybe risk reduce them a little bit, and you compare them to your growth goals, there's tends to be a disconnect. And I've always wondered why that was. And so that's part of the motivation for trying to figure out how companies can close that gap. And the discipline that I've landed on over and over again is a way to connect strategy to project execution, and portfolio management is the way to do that. So what I wrote about was first describing what this discipline of innovation portfolio management is and how you know when you're good. So I put in the book a maturity model that shows what's the difference. How do you know, what are the characteristics of a company that is really doing this discipline well? And then I wrote about how to build a capability. So a lot of the book is about, it's really a how to build the capability. And that covers everything from portfolio, how to structure your portfolio, how to govern and make decisions in a portfolio, how to handle resource management, how data flows, what kind of tools you can use to enable these practices, and what kind of forums work best for making these types of decisions. And then much of the last third of the book, I would say, is about um, the organizational change that's needed to get a large organization to adopt these practices. So a lot of the hardest part of what I do is not helping companies implement a new process or select and implement a tool. The hardest part is the behavior change. How do you overcome that resistance to change when you're implementing a new way of working that everybody might not support? So I put a lot of effort and research into figuring out what are some of those typical barriers that I've run into and how to overcome them. And then there's a little bit of discussion about AI and how that's impacting this discipline, what I see going forward in terms of technology. And that's pretty much it in a nutshell. So it's currently available for pre-order. It launches in September.
Oh, great! I look forward to it. Definitely add to my list. So let's get started and let's get to the core of the discussion today as to why strategy execution fails. Uh, Most of the organizations today are responding to various priorities, as you would acknowledge, whether it's AI transformation, their AI ambitions, whether it's emerging cyber security risks, economic uncertainty right now, as well as the evolving customer experiences, right? But even for planning and executing their strategies, now they also have good planning tools. As I said, they have rich data sets. More importantly, I would also argue that there is greater executive focus, but still many organizations continue to struggle to execute their strategies, right? And when I was doing some homework for our podcast, our episode, I came across a Project Management Institute paper which said that only 50% of projects really delivered their intended business value, right? Which indicates to me that it's not necessarily just a delivery problem; it's potentially a bigger organization discipline problem. And I wanted to start there our conversation. um, when we say that, based on your experience, when we see that strategy execution often fails, where does it often happen? Is it at the leadership level? Is it the middle management that typically actually plays the role whether strategies fail, succeeds or fails, or it really happens on the ground at the delivery level?
Yeah, there's a lot to unpack there. So eh, there's a number of ways to kind of look at where the typical failure points are. And first off, the environment we're working in today, and you kind of acknowledged the world is changing very quickly. Customer buying behaviors are changing faster than ever. That you've got new technologies that are opening up completely new business models. A large business can get disrupted by a single person with a laptop,
Yeah.
uh, leveraging AI tools, and the macroeconomic conditions are always changing. So
Mm.
we can't just in the maybe in the last century and even to this day, I've found companies have an annual operating plan process where they might start in September and create their plan for the following year. They lock in on a plan and then they execute throughout the year. Well, that doesn't cut it anymore because things are changing. And what I talk about in the book is you need to revisit that strategy throughout the year and just ask yourself, what's changed in the last 2 or 3 months? And do we need to maybe pivot or adopt our strategy? Maybe not, but let's at least look at it. Us, lift our heads up, look around at the environment, what's going on with our competition, what's going on with technology change, and most importantly, what's going on with our customers. And let's ask ourselves, are the plans that we put in place at the beginning of the year and budgeted cross functions and are those still valid? And if not, what do we do about it? Do we need to possibly change our priorities? Do we need to possibly reprioritize? Do we need to reallocate resources? So part of it is learning to be more dynamic than ever before. And in terms of failure modes, though, the other the other one that I see over and over again is we tend to load our scarce resources to capacity or even beyond capacity, and tell them to execute. And that's really setting up our project teams in the innovation world that I work in, where you have project teams that need a certain level of resources cross functionally, and sometimes those resources are shared with other projects or other businesses. You need a way to allocate those resources so the resources are real. And when you say we're going to invest in your project, that you're going to get the resources that you feel you need to execute to your plan. And when you load to capacity and beyond, um, the whole pipeline of projects that you're working on, you end up getting lots of constraints. There's always bottlenecks. There's certain bottleneck functions, and without the visibility into where those constraints are, leadership doesn't have a way to make decisions, either to outsource or shift project timelines in order to free up capacity for those bottlenecks. Yeah, I'd even go so far as suggesting that you need to plan with a buffer. Maybe you only plan to 15 to 80 or 85% of capacity, knowing that conditions are going to change and projects aren't going to always deliver exactly to the plan. Because it's better to say no to some things and do less and improve that throughput. So the metric needs to change to throughput, not how busy. If we're keeping people 110, 150, 15% utilized, and I've seen that, then we're setting ourselves up for failure. And those bottlenecks don't always happen in engineering or the scientific area. If it's a pharmaceutical company or a healthcare company, then the bottlenecks typically happen in some support functions like regulatory affairs or manufacturing or quality. Then that bottleneck's going to slow down the whole pipeline. So that understanding that resource allocation process is really leadership's job. Is to the way you take strategy and execute on a strategy. It's always about decisions on where you're going to put those scarce resources. And if you're not doing those efficiently, if you don't have the visibility into where the constraints are, then you're going to run into problems
Yeah.
in execution. Yeah.
Yeah. And what role, based on your experience again, does the organization structure overall play, whether the strategy succeeds or fails?
Yeah, that's an important question. So you have that as part of the governance of the decision making. Most of the companies I work with are very large. You might have a corporate strategy, and then beneath the corporation, at the corporate level, you have maybe 3 or 4 different segments. Within the segments, you have multiple business units. Within the business units, you have multiple product lines. So there's this hierarchy, and you need to make sure decision making is happening, number one, closest to where you have the understanding of what's going on in your markets. So you could argue that decentralized decision making is important, but it also has to connect back up to the higher level corporate segment strategy. So figuring out that org structure, that corporate structure, and where resource allocation decisions need to be made is an important one. And it gets even more complex when you're sharing resources. Some companies, they'll develop platforms or digital technology that crosses over business units. And that means you have shared resources and some support functions. Like, let's just use regulatory affairs as an example. That might be a centralized function that sits where you're sharing resources across different business units. So it's really important to figure out where to govern and at what level in that hierarchy you're making those investment allocation decisions. And the rule of thumb I use is you're making those decisions where the people are allocated to projects, and that's typically at the business unit level for these large companies. So at the business unit level, where you have a cross-functional leadership team, each of those leaders needs to align on project priorities and figure out how do we staff our teams for success at that level. But at the same time, corporate is managing a portfolio of business units. So you have to get the governance structure in the right place and make sure that you're empowering with the decision makers that know their businesses, and it might be at the P&L level or the business unit level. And then you always have to be able to roll up the uh, the projections to the right level above that, so you can make sure that everything is in alignment. So it's that cascading effect. Corporate strategy cascades down to the segments, to the business units, and then back up through the project execution and the data. And making sure top down and bottoms up are aligned. That strategic alignment is really at the crux of what this portfolio management discipline is all about.
Yeah, yeah, absolutely. And for executive leadership, when they have endorsed the strategy, based on your experience, where they can see the early signs or where they can actually look for the indicators to see either strategy is progressing well, it is succeeding, or there are signs that strategy potentially is heading in the wrong direction, and they need to intervene.
Yeah, the form I think where it all comes together is what I'd call portfolio review. And in most organizations, a quarterly cadence makes sense. But some organizations where you might have a 10-year development life cycle, it's not that frequent. In other organizations, like I worked in the cell phone industry for a while, and a cell phone's life cycle is, at the time was 6 months at best before it's becoming old technology. So you might want a more rapid cadence. So it really is the cadence of those portfolio reviews really depend on the industry, the markets, and how crowded your pipelines are with how many projects. So there's a number of factors that go into deciding that. So if we assume it's a quarterly cadence, that's where you go in and check and say, okay, here's our product line roadmaps, here's our strategy, and ask the question, what's changed in the marketplace? What's changed regarding our customer behaviors? Has something happened regarding competitors? Or is there a threat of disruption? Are there some weak signals coming? Do we need to start thinking about jumping to a new S curve in technology?
Mm.
And so you need to again look at uh, what's changed, so you can revisit that strategy, and then it becomes a conversation about are we investing in the right places, and you often need to always be thinking, what should we not do in order to accelerate the things that we should do. So when you roll up the portfolio, there's typically, there should be a prioritized list of projects that are in alignment with your strategy, but there's always going to be some what we might call pet projects or zombie projects, or projects that are languishing that we're investing in but aren't quite getting the bang for the buck we expect. We need to call those out and make some tough decisions, and really ignore the sunk costs, and look at going forward. Does it still make sense to invest in this project when we have this other larger opportunity in a larger growing market coming? I worked with a client recently where they were spending over 50% of their R&D dollars on an aging product line, where most of their money was going to kind of keeping it alive in terms of sustaining and maintaining an aging product line, and they were never able to kind of cut that off, because their incentive was to meet their next quarterly numbers. And if we cut off and move that investment to a faster growth market, that put their short-term their short-term return at risk. So that's where you have to make some tough decisions and decide, do we have a balanced portfolio? Are we investing enough in the long term and or the medium term? Because if you keep just focused on the short term, you're going to eventually get leapfrogged or disrupted. So having that balanced portfolio is another metric we like to look at the portfolio review. If our strategy is to grow double digits, we can't keep investing in safe product line extensions or incremental innovation. We have to have some high risk reward kinds of projects in our portfolio. And so that project mix is another factor that you need to really think about. Is it, if we want to grow at a certain rate, is our product mix the right mix in order to achieve that objective?
Yeah, rightly said. And I want to unpack many of the points you just said a little bit more details later. But just on looking at this whole problem from another angle of investment planning, and as you said, the traditional way of investment planning is no longer becoming relevant, but many organizations still continue to do annual investment plan, right? The behavior generally you see, and you would have come across this in many organizations, that yes, there is a very good strategy that has been outlined. There is a good alignment at the board level, executive level, etc. But when it comes to the corporate annual investment planning, that's where it starts derailing, in the sense that every department they come with their own priorities. You start seeing plethora of business cases, each business case focusing on their department's local ambitions. Um, while the business case itself as a standalone may be justifiable, but it may not actually directly relate to the strategic intent that the organization wants to go to, right? And all of a sudden now you see uh, tens of hundreds of initiatives emerging across the organization, right? And my question basically to you is, how organizations and the leadership in particular should address this behavior? Because this happens, I've seen this happening many times, where there is a very good strategy, but when it comes to the investment planning, it starts fading away. That's the first potentially point where things start derailing.
Yeah, well, it's in leadership needs to, for starters, they need to uh, supply the teams at all levels of the organization with some guardrails or some boundary conditions.
Mm.
Our strategy, where to play and how to win for us, looking at our core competencies, where the markets are growing, where the customer challenges are. Um, we need to outline that so we're not off building flying cars. Where there's a strategic fit question that needs to be asked. So it needs to be made clear to the organization so they're not coming to leadership or the decision makers with projects that don't necessarily fit the direction the company is going, however that is defined. So that's an important part. The other thing I'd say is you can't just rely on the financials. Um, when there's high uncertainty, when you're going after high risk reward opportunities, there's going to be lots of unknowns, and those unknowns are based on a set of assumptions. So you need to have customer evidence that or strong evidence that shows we're progressing this investment or this project in the right direction. It's not all about the NPV or the ROI. There are some qualitative criteria you need to look at. For example, well, number one, does it fit our strategy, where we want to go with the organization? But there's also things like operational leverage. Are we going to leverage our infrastructure, our core competencies? Do we have a right to win in the marketplace for this opportunity that you want us to invest in? And there's also risk that needs to be understood. These are things that are hard to put a number on. There's lots of uncertainty. So some companies turn to a scoring mechanism. They might turn to like a rubric where they score strategic fit, operational leverage, some of these more qualitative criteria. But there's no algorithm that's going to tell you how to prioritize your projects or how to invest in your projects. That's just a starting point for a conversation where the right people that understand the markets get around the table and have a conversation and decide what we're going to invest in, what we're going to say no to. And they might have the financials or a risk adjusted financials for the project, but they also are thinking about that qualitative criteria as well. And at the end of the day, it's a conversation where you get in front of the whiteboard and figure out what are we have to draw the line somewhere. What are we going to say no to in order to pursue some of these opportunities? So those are the two main things: understanding qualitative and quantitative criteria and agreeing on what the criteria is, so it brings objectivity to the decision process. Too often it's the hippo or the highest paid person in the room, right? You want agreed evaluation criteria, so when you do make a decision, everybody knows what you're going to weigh the most, and you can quickly get to a decision, and even the teams that are presenting their projects know how they're going to be measured. One last thing I just thought of is more cultural. I think it's okay for a team to come to leadership and say, we recommend that we don't invest in our project because we went out, talked to some customers and found out that they will not pay for this, or there's not a scalable business case here. So when you have a culture where it's okay to fail, where it's okay to recommend that we do not invest in a project, that says a lot. And instead of, looking at it as a failure, you look at it as that's a win because we saved our company from investing in further in something that we know is not going to win in the marketplace. So look at all the money we saved. Now those engineers, now those the people on the team could go work on something that's more valuable for the company. So there's the cultural side of this as well, and that's easier said than done. But in most companies, when your project gets canceled, it's viewed as a failure, and that kind of culture doesn't change overnight.
Yeah. In the strategy planning and execution part, there is always a tension between as you said, the longer term ambitions and where we should be disproportionately investing to realize those longer term goals. But at the same time, every organization has its own, I would say, incremental annual OKRs that they need to meet. With the financial targets every year they need to meet, and so on and so forth. And that there is always distraction as to how much they should allocate funds to that realize those longer term goals, which is potentially the accelerated initiatives, etc. Where and how much they should allocate to these programs or initiatives which deliver only incremental value just to meet their yearly targets. Is there any kind of pattern magic formula there as to how much organizations should allocate to these strategic investments versus the incremental investments?
The shorter term, there's no magic formula because it really depends on your strategy. And if you have an aggressive growth goal, you need to have that mix is going to be very different than steady incremental growth. And the hard part is once you establish that investment mix, a lot of companies look at it as investing in the core adjacencies and more transformative, high risk reward kinds of opportunities. If you put it into those three buckets, the numbers 70, 20, 10 gets thrown around in terms of percentages, but that's just a starting point for a conversation. It really, every individual company can make their own investment mix percentages, if you will. Where I get nervous is when you say you want some investment in the longer term, and then when you actually roll up the projects, you're actually spending a very small amount, if anything, in those longer term, because the near term is going to win out every time because that's really the way a lot of leaders are incented. They're incented to hit their quarter over quarter numbers. So it's hard to talk about this topic without getting into incentive systems and how leaders are measured. But the really, the leading companies out there have figured out that, it's a combination. You're measuring your leaders not just on the short term, you're also measuring them on progress towards that next generation of product lines. And again, I'm talking products in my world. It's products, solutions, services, whatever it might be. So investing enough, and you don't have to, when it comes to investing in those longer term, high risk reward projects, we're not saying bet the farm on one or two projects. We're saying there's something called metered funding. Let's just invest enough to learn. So when you're investing, let's say you kick off a portfolio of long-term types of projects in those high uncertainty, where there's new sources of growth outside of the core business. Let's invest in a portfolio and just invest in small increments or tranches of funding, enough for the teams to go out and de-risk quickly and identify what are the big unknowns, not just technology unknowns, but also business case viability unknowns or the customer need unknowns. And let's really understand that customer problem and then let's invest more in these tranches. So the worst thing you can do is throw millions of dollars at a new growth source opportunity and the teams are going to spend that, and then you find out, and and then you don't survive first contact with the customer. So learning how to meter your funding for those longer term, but having the overall budget to establish a portfolio of those longer term new growth sources kinds of projects is important. And every company is going to have their own mix.
Yeah. And how important it is in your view to get the shareholders aligned to this vision and this strategic plan, where they need to be sometimes across the fact that we are investing into these particular capabilities to realize certain outcomes after 3 years, etc., which might mean that our incremental year-on-year growth in certain product portfolios may remain just moderate for some time. And how you convey that message to the shareholders and then get them aligned?
Yeah, I think it's educating them on the realities of your marketplace. I mean, why did SpaceX get the kind of valuation it got when it went public? And the shareholders are counting on the future. That they can't point to any one project that's going to get them to realize a return on a shareholder investment. So it really is about understanding what's going on in your markets, what's going on with the pace of change, the pace of technology change, what new business models, what disruptive threats there are in your markets, and painting that picture for your shareholders and your board ultimately to where they understand that you have to have a more balanced. You need to shape your portfolio a certain way, and that might mean sacrificing short-term growth for the long term. I mean, you look at companies like Garmin. I write about Garmin in my book. I mean, they were in a position in the early 2000s where they were making GPS devices, and then cell phones took off, and you don't need a GPS device on your car, a separate device on your car anymore. Yet they're still around today, and they've grown tremendously in market value because they were thinking about, they saw this disruptive threat coming, and they diversified their portfolio. They got into other, they leveraged their core competencies and got into a bunch of other different categories in order to, while one category, their main business was dying, they got into a bunch of other growth categories like fitness watches and there's a whole list of new categories that they went after, and they're still around for that reason. I mean, there's the other example that academics like to use is what happened to Kodak versus Fujifilm. Kodak, they went down and didn't embrace digital the way, and then Fuji invested their technology in skincare and things outside of the analog film markets, and Fuji was able to overcome.
And what happened to Blockbuster with the arrival of Netflix?
Yeah. So we make this sound easy, and there's a little bit of a halo effect going on. After the fact, we can look back and play Monday morning quarterback, but we certainly need to learn some lessons from that. And when communicating with shareholders and the board, that's where it's almost like the CEO needs to explain why you're not going to see the growth that you're in the short term. We're going to take some of that and invest in where the market's heading, not where we are today, and for the following reasons. And I mean, Apple, all the leaders that we all know of have been able to do that. NVIDIA, they're able to articulate to the board and shareholders why that the investments that got them here aren't going to get them there in a nutshell.
Yeah. Okay, let's shift our focus to the portfolio management aspect of this, because that's another angle I wanted to explore with you as to how it helps for successful strategy execution. Now, we know that the strategy, let's assume the strategy has been well defined. There is a potentially some positive funding that has been allocated. And but some many times what happens is when the projects start, in investments commence, many organizations take the approach of project-based investment than, let's say, a capability-based or in nowadays product-based investment approaches to this, for a strategic portfolio. And what I mean by that is, the project is stood up, it delivers certain value for in year, right? And then project gets wind down, right? And that whatever capability has been half baked, that remains half baked. There is no further continuous evolution of that capability to continuously deliver future outcomes for the business. Um, Many organizations still have not pivoted to that capability centric or product centric way of investments. Um, where do you see that in terms of, what is the behavior change that needs to happen within organizations, and what portfolio strategy they need to adopt to do this more longer term capability and product centric investment?
So if I understood your question correctly, the model of investing in a project, launching it, then moving on to another.
That's right. That's the behavior many organizations have. Instead of looking at this, build a capability and completely
Uh,
and then use that capability to deliver new features, build
yeah,
products, and continuously evolve those products. That behavior is not there for many organizations.
yeah. There's techniques like product line road mapping where you're not just thinking of the next product, you're thinking of the next one, the next one, the next one, and then when do you have to jump to a new S curve? When do you have to jump to a new platform, if you will, that spurs another generation of projects? So, and there's a technique called future back. Some call it different things, but we're looking out 10 plus years. Where do we want to be? And then what are the stepping stones to get there? So you're never just thinking, one and done. You're thinking, we have a strategy to be at a certain place in 10 years. What are the building blocks? What are the products or technologies where we're going to get there? We're not going to get there. We're not going to wait 10 years to launch our first product. We're going to come out with this product in year one, and then we're going to enhance it this way. And then we're going to leverage a new technology that wasn't available in year one and year four, and thinking through that technology and product line roadmap. And I like to think of it as stepping stones to get to that future state of where you want to be. Apple has been excellent at doing this. Now that nobody can project with a crystal ball. Nobody has the crystal ball to understand exactly what's going to be needed in 10 years, but you have the ability to pivot along the way. So you have more of a North Star. We're marching to. We think the market is going to need this new business model or new service or new product, and along the way we have to recognize that the path there is not going to be linear. There's going to be, based on what we learn along the way and what changes happen in the market, but that North Star doesn't change. And let's make sure that that's a viable customer centric thing that we know the customers are going to want. We're solving a major problem that isn't solved today. So that's the approach. You need to have those product line roadmaps. You need to revisit them at your quarterly portfolio reviews to see what's changed. You need to modify some things. Maybe our projects aren't launching on time for one reason or another, and we need to tweak them or change them. Maybe we don't have the resources like we thought we would have to execute. So it's an evolving plan. But we need to revisit it throughout the year and not just in the annual planning process.
Yeah. And one of the challenges I see in the portfolio management is not necessarily just funding the important initiatives, but also, and I think you touched base on this, but also have courage to stop initiatives which are no longer relevant to our strategy, right? But the fact on the ground remains that many initiatives continue to drag because those could be, let's say, pet projects for certain sponsors. Some could be politically motivated. So, from good portfolio management and governance perspective, what are the what objective criteria, etc., that in your organization should consider to really assess projects on for their relevance for future strategy, and have that honest conversation whether we should continue to fund them or we should pivot the funding to something else.
Yeah, the you should always be thinking about rationalizing your portfolio, and it might be because the economic conditions changed. Like the last recession we had, it forced companies to rationalize their portfolios. They had to do more with less. In other words, so they had to do what I'd call a pipeline clean out, and they said we're going to have to kill some of these poor projects. But to your question of what kind of criteria you use to figure out what to say no to free up capacity to the things that are really going to move the needle. Most companies will look at some kind of ROI metric, whether it be NPV, IRR, or payback. Those are pretty standard, and they're based off projections. So I always encourage companies to really understand what are the major driver assumptions of the business case for your projects, and let's really test those assumptions that you're making and build our confidence in those business plans that we're making those decisions off of. As you get into higher uncertainty territory, then you get into more complex analysis tools that allow you to try to put a number on uncertainty. So things like Monte Carlo analysis or earned value, there are certain techniques where you can use to better understand that incorporate the risk component. The thing that I've been heavily leaning on the last maybe decade or so is the evidence, just getting out of the building, talking to customers, running experiments on those high impact unknowns, those assumptions that you're making. What has to be true for this business case to work? Scott Cook from Intuit famously said, we had lots of failures who, their initial business case looked awesome, right? So, when you're dealing in high uncertainty territory, when you're going into new markets with new technologies, then your business case is almost worthless because we're just guessing at the growth rates because it's never been done before by definition. So those hockey stick growth curves can be meaningless. It's more important to identify what are the high impact assumptions that we're making, and let's go and test those assumptions. And it could be technology assumptions. It could be the business case. What is the business model? Assumptions are we making? How much can we charge? What is the cost structure? It could also be the desirability assumptions that we're making. We're assuming that people are going to want to order a taxi on their phone and be picked up by a stranger. So what are those unknowns, or what are those assumptions or hypotheses we're making across those different dimensions? And then let's go test those and build our confidence. And the testing that we do is something we call call to action experiments. Let's run an experiment. We don't have to build. A lot of companies make the mistake of rushing to build something before they've answered the question: is this even a viable, scalable business? So there's lots we can test with customers without even building anything. There's lots of techniques out there to get that value exchange and learn, whether it be asking for the customer's time to observe a demo, or a letter of intent to buy the product when it's ready. It's because customers are going to typically tell you what you want to hear. They're going to say, "Yeah, sure, that sounds good. We would buy that." And then when it comes to actually spending money, they give you a different answer. So that's where the strength of evidence becomes very important. It's easier to give somebody your email address than it is to give them your social security number. So one is a higher bar than the other. So when we're running these experiments, let's get that evidence. Let's set a benchmark and say, or a threshold. 3 out of every 4 people are going to show up for a 3-hour meeting, a 3-hour demo on this new idea that we have. And when we ask, and it's only 1%, then we know that something's wrong in our assumption, and we need to maybe pivot or move off that project to something that's looking more promising. So that evidence strength is a real important way to build the confidence instead of just relying on the financials.
Yeah. And what approach organizations can consider in effectively managing their limited talent pool, then the resourcing capacity in delivering their strategy? Because many organizations, many people still think that funding is the most important input for successful execution of strategy. But um, at least my observation has been, and I read somewhere as well, that um, it's not necessarily funding, but more about the availability of your limited capacity and how you optimize it. That is the more bottleneck, the bigger bottleneck, because
Yeah.
most organizations work within the fixed capacity model these days. So how do you, from portfolio management perspective as well, how do you make sure your talent is properly allocated to the most strategic initiatives, which will deliver greater value to you?
Yeah, often the constraint is not money or capital equipment. It's typically in most organizations I work with, it's people with a certain
Mhm.
skill set. So that gets you can't do effective portfolio management without looking at your people resource allocation.
Mhm.
So they go hand in hand. So you have to do an honest assessment of supply and demand. What is our capacity in our people? What are the different roles? What are the different skill sets we need to execute our overall portfolio plan? And when you have the right tools in your system, you can, whether it be full-time equivalent people by role, you can project out what we're going to need over the course of 12 months or more, or in some cases when you're starting out, it's less. And where are those constraints? So you have to always be looking and managing that. Like I said, when we started our conversation, you're always looking at where the constraints are, so you can be proactive about dealing with them. What happens too often is when we see that skill set or that human resource we need to put towards our initiative or our project, we typically often find out and we're at the last minute, and we're very reactive, and that's where things
Mhm.
start to break down. You get a lot of churn in your pipeline. So it's that visibility which comes with good planning tools. And when we see that there's a constraint, what do we do about it? And it's not always about stopping projects, although that we've already talked is one approach. The other approach might be to outsource. Maybe that's that bottleneck, that chronic bottleneck function. Maybe there's a third party that can do that to handle some of the to allow us more flexibility to flex capacity without hiring a bunch of people. So that might be an option. And then you might want to stagger your projects so everything's not headed towards a pinch point or a bottleneck in that skill set. Too often there's that specialty skill set that's wanted on every project team, and there's only one or more, a few of those people to go around. Or it's we're talking a lot about people, but it could be in one company I work with, it was certain type of lab equipment, but it's more often than not it's the people, and having the visibility of where the constraints are and being proactive about it is the best way to manage that.
Yeah. The other angle I wanted to unpack with you was how effectively measure the success of the strategy itself. Um, because what I've seen many times is when organizations come up with the initiatives, etc., most of the success measures are more operational in nature as to the how effectively they are managing budgets, how effectively they're delivering projects and milestones within times, etc. While they are good for effective tracking of the project, these measures do not tell us anything about whether we are succeeding in our strategy or not, right? So, what are the real success measures that executive leadership would be looking for, in your view, that any organization, a good portfolio management should be focusing on?
Yeah, what you're talking about. I mean, I've been part of teams. I've learned some hard lessons. We got the product to market on time. We won all kinds of awards for our efficiency and effectiveness at delivering the product. We hit our schedule milestones. We hit our budget, and it failed in the marketplace. So it's not just executing on the project. It's also making sure we pick the right projects, and we're investing in the right projects based on our customer needs and where the markets are heading. And there's the one way to measure that is your standard return on R&D investment, or your, one metric I like to use is the amount you're spending on wasted development. So wasted development spending is basically just what we're spending on projects that either don't make it to market or fail in the marketplace. It's never going to be zero, but we need to make sure that number is trending in the right direction. So there's return on R&D investment, but those are very much lagging indicators. You're not going to find it if your overall innovation process, your innovation pipeline, your product development pipeline. Some of these projects might take 3 years to get to market, and then they ramp up over the course of several years to peak volumes. So that return on investment can be a lagging indicator, or I should say, return on your innovation investment. The more leading indicators I think you have to keep your eye on are things like progress metrics. What is our learning velocity is one way to measure that. How quickly are we learning about the viability of our new projects, our new initiatives, and learning quickly and learning to say no quickly so we can invest in other things. So gathering those kinds of learning metrics is more of a leading indicator of, and then investing after it's showing promise. Those are some things you can look at that aren't like after the fact. But yeah, overall, the board, the shareholders are going to look at your growth from innovation. There's vitality metrics is the other one that is very common. What is our revenue from new products? Whether it be products that are still on the upslope of their life cycle. What is what percentage of our revenue is coming from new? And that example I gave earlier about the company that was spending lots of money on an aging product line, their vitality metric was terrible. They were spending their R&D dollars just keeping an old product line alive. So if you looked at their vitality metric, it was very poor. So they weren't replenishing in a continuous way to keep their customers buying more. So vitality is another important one.
So Noel, as we start now wrapping down, I wanted to get your thoughts on the AI strategies around AI in particular, because I don't think any conversation nowadays can be complete without having anything on AI, any discussion on AI. As organizations start building their AI strategies, which most of the organizations are doing these days, what it means in terms, is there any specific consideration that is now popping up, surfacing, that organizations should consider when to build AI strategies, in your view, and particularly the measures and the investments and the risks considerations around AI strategy?
Yeah, I think of AI like any other technology. I'm constantly working with my clients and advising them to fall in love with the problem, not the AI solution. Let's first understand, what is the use case? What is the problem that you're solving with this technology, with this AI technology? There's wonderful things that it can do to open up new business models, new opportunities, but we're often too quick to jump to those solutions without really making sure that there is a important underserved problem out in the marketplace that it's going to solve. So that's the first thing I would say. And then leveraging the number of opportunities it's opening up. In my world, where I'm helping companies to improve the effectiveness of new product development and innovation, there are some amazing things that we're already starting to see with regard to a better schedule predictability. For example, by using LLMs to really understand your history of delivering projects of a certain complexity. If you can understand that, if you have the data, the projects, you have the actuals and the plans, and you can learn from the variances that you're seeing over time, you get a starting point for teams to plan. So, for example, if your project complexity is low, medium, or high, let's say it's medium complexity, then you can look at least get a project plan and some of the risks. The smart schedule, AI can assist with scheduling based on history. So that's one area where I think I see us starting to leverage AI in the innovation space. Another one is the resource allocation challenge that we talked about, where again, based on your history and your resource requirements for certain project complexity categories, you can leverage AI to figure out what your resource profile is going to look like. Depending on a certain parameters, you can, and over time you get better planning accuracy on your resource profile, which leads to better throughput, leads to better understanding of where resources need to be allocated. So those are two areas. And then optimizing your portfolio as a whole, leveraging AI. And I don't think we're quite there yet, but leveraging AI to figure out what is that optimal portfolio where we're going to maximize the value of our portfolio. So it's understanding the project data as the input, making sure that, I think we've learned by now that AI is only as good as the data sets that you're leveraging, right? So, you can over time, I think we're going to see some not only faster, but smarter decision making on managing that shaping that portfolio based on the, what the data is telling us from past performance. What it won't help us with is, those future needs and coming out with solutions that have never been done before. So we just have to always keep in mind that at best, it's leveraging the past in order to inform us to make better decisions for the future. So today it's more of an assistant, an extra person on the team that's going to, I'm using it more and more. My clients are using it more and more, but more as another player on the team that is, but it's not quite at the point where it's making decisions for you, but it's certainly augmenting the work that you're doing. It's certainly making it more efficient. So when we talked about setting up experiments to validate assumptions in a business model for a new product or a new offering, it can do amazing things very quickly to help you design an experiment or to help you figure out what the high impact, riskiest assumptions are going to be. And it can help you kind of scan the marketplace and get a lot of a good data and insights. So we can and what I'm reading about a lot lately is the ability to come up with prototypes and low fidelity prototypes, getting them in front of the customers and learning. We can do that quicker than ever before with vibe coding and things like that. So the problem with that, though, is you still need to make sure that you're solving a problem. So again, you can come up with solutions very quickly and test those solutions, but you need to make sure you're testing the viability of the business model. You're making sure that you're solving a real important customer problem, regardless of the AI.
Yeah. Cool. On that note, Noel, thanks for your time. I think this was a really wonderful discussion. There are definitely many takeaways for our audience. I would say that my takeaway in particular, Noel, is the strategy execution is not just a delivery problem. In fact, far from it. It's a reflection of the operating model, the incentives for the leadership, how the budgeting works, the funding cycle works, how the portfolio management works in terms of optimizing or identifying the most important initiatives, and importantly, what initiatives we should pause, right? So there are so many aspects to this to really make sure the strategy really executed correctly. So thanks again for...
Yeah, that's why I the title of the book is Portfolio Management, but linking strategy to execution.
Exactly.
I view it as a critical capability for exactly what this discussion's been all about. It's executing that strategy, and it doesn't get a lot talked about a lot, but it's certainly an important discipline that is really that connection point between strategy and execution. So can't emphasize that enough.
If you found this discussion valuable, please follow and subscribe to Enterprise Tech Talk. And thanks for listening. I look forward to seeing you in the next episode.